Good morning, everyone, and thank you for attending this wrap-up session. I'm delighted to welcome James Brown from Lang LaSalle, the UK director, and well recognized as an expert on retail. James, you've been attending MAPIC for many years now, and it's the second year that you're leading this wrap-up. And I would like to thank you very much for accepting doing that. Looking back on those 3 days at MAPIC through your expert eyes, I know that you will provide this audience with an overview of where the industry stands, as well as a useful strategic advice to foresee its evolutions and new trends. James, it's all yours.
Thank you very much. Thank you. Good morning. I'd like to start firstly by saying a huge thanks to Reed Medium for inviting me back again this year to do this wrap-up session and for looking after me through my stay here at MAPIC. I'd also like to thank all of you here today for turning up for this last session of what's been a very good MAPIC. Last year at the wrap-up, I titled the session Adapting for Change. And I think having gone through another full year of change, I think we're likely to see continued change for some time to come. But I think the emphasis now is shifting also towards positioning for growth. I want to have a look back at where we've come from. So what's happened since we were here this time last year? Let's take a look back. We talked to three different economic recovery scenarios in the Eurozone. This time last year, we had an upside scenario, which was scenario 1. We had a central scenario, which was scenario 2, which was muddling through, and then a downside scenario, which was scenario 3 there. A scenario 1, we had a 20% probability to, which is a swift resolution to the Eurozone debt crisis, followed by a strong economic recovery driven by corporate investment. That has reduced now to 10% and is looking less likely by the day. But we stick with our central scenario for economic recovery, which we now have 60% probability to, up from 50% this time last year. And that recovery is really just a case of muddling through, and some way we will get through this and we will return to growth. Currently, obviously, we're back in recession in the Eurozone, but no doubt there will be growth on the horizon. If we also look back at where we were with regards to consumer confidence and retail trade confidence this time last year, you will see here back in October 2011 pre-MAPIC and here October 2012 pre-MAPIC, the consumer confidence is in red and the retail trade confidence in grey. This clearly shows that there has been a slight deterioration on both measures since this time last year. So in terms of sentiment, slight deterioration. And if you break that down and look on a country-by-country basis, this chart shows where consumer confidence in each European market or a sample of European markets sits relative to long-term average. Each and every country currently has a consumer confidence index which is below their respective long-term averages. And the red bars on this chart shows where the consumer confidence was this time last year. So this clearly shows some improvement perhaps in Greece's consumer confidence, but equally some deterioration in Germany and also in Poland as the markets have slowed. And then if we look at retail sales growth, clearly it is a real mixed message and a multi-speed retail sales growth recovery. A number of European states are currently seeing quite significant retail sales declines year on year. But you can see that we've got some strong growth to the east. Poland, Turkey, and Russia, three key markets which we talk to a great deal and have done a huge amount over the last few days as target growth markets for investors, developers, and retailers. In Central and Western Europe, again, relatively muted growth, but a return to growth nevertheless between now and 2014. And yet in Southern Europe, as we might expect, still some sales decline to come. What has fundamentally changed, though, and what is continuing to change at an alarming rate, is the extent to which the web and online and e-commerce is changing retail. And I think that's been the biggest change that we have seen between now and this time last year. The UK leads the global market when it comes to online. It is by far and away the most mature online market, but other markets in the world are catching up and are catching up fast. And in response to this change, retailers are changing to provide a true, seamless, multi-channel offer, because that's what's being required from the consumer. And we're seeing some amazing examples of innovation and trends globally that we can expect to see coming to our markets in Europe anytime soon. And for me, this Tesco's shopping wall in a train station in Korea is a fantastic example, albeit an old example, but a fantastic example of innovation and how we can bring that innovation and that technology into our physical retail environments. So for me, the biggest change in the last 12 months probably has been in the area of digital and technology and how that's evolving and how that's shaping the retail industry. Now, sort of looking at current day and looking forward and looking at the retailer, retailers in response to current cyclical headwinds and also in response to the structural change in e-commerce are changing how they do business. One of the key themes that has come out of MAPIC this year, and a continuation of a theme, is retailers' appetite for growth and expansion. And what we are seeing is a far more globalized retail market, with retailers looking beyond domestic markets to chase growth. And we've heard some fantastic stories about Brazil and India and China and markets outside of Europe. But equally, there are some very positive, strong stories to be told about growth in Europe. When we look at Istanbul in Turkey, if we look at St. Petersburg and Moscow in Russia, if we look at Poland. And the focus really, I think, is shifting away from perhaps looking at countries, but more looking at cities on a global level. Looking closer to home, we've recently undertaken a piece of work called Destination Europe, looking at international retailers and their expansion strategies and looking where they are represented throughout the European retail scene. We've looked at 250 international brands trading across the key European retail markets, primarily as a tool to identify the European retail roadmap. And this report, Destination Europe, there's a copy at the back there for anyone that's interested, highlights that London is ranked #1 when it comes to the international brands that trade within that city. It is still considered a springboard to Europe for many non-European brands as they test the European market. London is followed closely by Paris in that ranking, and then we start moving into Moscow. Moscow is rapidly ascending the rankings as it appeals to international retailers. It is a phenomenally successful, large market. We've heard a great deal about it over the last few days. Within that top-tier ranking, you also have the likes of the well-established core markets of Milan and Madrid and Rome and Munich, but equally, as we'll come on to in a second, the emergence of some of those growth markets that are appearing on retailers' growth strategies. So if we look at the top core markets and the top growth markets, here in red, London, Paris, Munich, Milan, Rome and Madrid, still very much on the radar for international retail expansion, but equally so is Moscow, St. Petersburg, Kiev, Istanbul, Prague and Warsaw. And in each of those cities and beyond, appetite for the right space in the right location is still strong for international retail brands. International borders are increasingly becoming less of a barrier to expansion. And as we've heard over the many days, and as we're seeing emerging, this strategy of targeting core markets at city level and then moving into strong regional cities is something that we will see more of going forward. If we then look at international retailer of origin, in other words, where are retailers coming from in our European retail cities, in first place it is Italy, and that's primarily driven by the origin of the luxury brands. So Italy is the biggest exporter of international retail to our European market. But the US is catching up fast. And in the last few years and in recent times, we've seen the influx of a number of new American retailers coming to Europe. as I said, via London, but then coming and looking at the rest of Europe for expansion. We're also seeing the arrival and the emergence of Chinese brands coming to London and no doubt shortly coming to the rest of Europe. And this is something and an increasing trend that's been talked about over the last few days and something we can expect to accelerate. We anticipate, therefore, that the US will overtake Italy this year as being the biggest exporter of brands to the European retail market. And then if I focus on luxury, we all know that luxury has really outperformed in recent times, despite the turbulence in the markets, partly driven by the success and growth of luxury, demand for luxury in the Far East and in the growth markets, including Moscow, Istanbul, and St. Petersburg closer to home. But what this shows is that there is this graph here, difficult to read, but it illustrates on this axis here the proportion of retail international luxury brands that are present within a market and prime rents on the bottom axis. And up in the top right there, we have London and Paris, which have the greatest proportion of luxury brands in our European retail marketplace and equally command the highest rents in those luxury pitches. And the reason for that is because the continued growth and appetite for luxury brands from consumers and for luxury brands to continue to grow and expand into international markets. And we anticipate that to continue. But they do have specific requirements for specific space in very tight prime locations. And there is a constrained supply of that stock in most European cities. And in that respect, that is helping to drive, or at least to maintain, luxury prime rents across our European high streets. There is also a trend, unsurprisingly, whereby the presence of international brands also correlates quite strongly with tourist population, tourist visitors within different European markets. So a very positive story for luxury and luxury high streets across Europe. When looking at legacy retailers, however, and looking at retailers that have been well established for many years in our European market, they still face some challenges, partly in response, as I said, to the economic headwinds, and partly in response to a changing retail model. And for legacy retailers, there will be further failure, there will be further consolidation, and there will be change in their portfolios in terms of where they open and where they trade. Now, this graph shows from a sample of 15,000 retail leases across Europe, the lease expiry profile of retail. And this shows, using the red bars, show the year-on-year percentage of leases that are due to expire each year across Europe, and the grey bars show the cumulative expiries over time. And what this clearly shows is that by 2014, almost 50% of existing leases in the European market will have expired. Now, the caveat to that is that this will differ by market, it will differ by scheme, it will differ by shopping centre or high street. But the point is that in a number of instances, these lease events, these lease expiries, will trigger change in our retail landscape. And it will either be in favour of the retailer as they renegotiate rents at more preferable terms in order to stay trading, or it will be in favour of the landlord as they take the opportunity in prime locations to drive rents. Nevertheless, it is this profile and it is these lease events that will accelerate change over the coming years. Now, just moving on to the owner and the developer. We've heard a lot about new developments coming out the ground over the coming years, but there has, without a shadow of a doubt, been a huge focus towards the country of honour, Russia and Turkey. Both of those markets, strong demographics, strong growth prospects, and overall an undersupply of modern retail stock. Together, those two markets account for almost 45% of all stock that currently is in the development pipeline. So this is a shopping centre development pipeline. So a staggering figure. And the majority of that will be new development. As you can see, the development pipeline thereafter for the rest of Europe falls away quite aggressively. And I think what we're going to see now from here on in Western Europe is, whilst there will be exceptions and there will be the big players that will continue to develop the real major developments, the showstoppers, we're likely to see the rest of the Western European retail stock being ripe for redevelopment. And redevelopment, in effect, will become the new development. And asset management will be required in order to drive some of those legacy and older schemes forward. So going forward, it's unlikely that we're going to see a huge wave of new developments coming online in Western Europe. For now, that's very much focused on the growth markets, in particular of Russia and Turkey. We've heard a lot about asset management and what we need to do in order to make our shopping centres across Europe succeed. How do we differentiate them from the competitors? How do we differentiate them from an online experience? And there have been a number of things that have been discussed and continue to be discussed in order to help us to identify what we need to do. What are the key ingredients for a successful shopping centre in a multi-channel world? Now, retail will no doubt always stay at the core and at the centre. But in addition to the retail, there are other uses that are required in order to create that point of difference. We've heard about leisure. We've heard about the huge success and growth of catering. We've talked about the uniqueness and dynamism of pop-ups and the ability to change mix over time. We've also heard about the importance of service within the physical environment to compete with the high levels of service that the customer gets online. Click and collect and embracing click and collect and bringing it in to the physical store environment, or for shopping centres to take control of click and collect in order to provide an optimum service. We've also heard about trying to bring culture and education into shopping centres throughout Europe in order to improve that engagement with the local community. We've also heard about embracing digital and trying better to use digital, social media, and various digital platforms in order to improve the physical retail environment, or to improve the relationship that the landlord has with the end consumer. To listen and to communicate, and ultimately it's all about knowing the consumer. Whether that's for a shopping centre, whether that's for a retailer, a factory outlet centre, or any other type of retail environment, knowing the customer in this fast-changing world is becoming more increasingly important. We've talked about new opportunities for development or redevelopment, and travel hubs was a topic that was talked at great length a few days ago. Airports, airport retail, or train termini throughout Europe. I did a quick calculation. Europe's top airports have a combined 1.34 billion visitors passing through them each year. That's the equivalent to almost 45 Westfield Londons. So a huge supply of latent demand as people travel through these airports and through these train stations. But understanding the consumer is paramount, and we heard this when the experts in these fields were discussing it the other day. The consumer travelling through airports and train stations is very different from the consumer that travels through shopping centres. And what we're seeing is a new type of retail and leisure being created within these travel hubs in order to capitalise upon that huge visitor number that pass through our European travel hubs. Moving on to the investor. The investment market continues, although it is currently favouring prime product, and that's perhaps unsurprising considering the uncertainty that exists in the market. This graph shows retail investment volumes in Europe in the year to date, the first 3 quarters of 2011. And it shows that actually investment volumes overall this year are about 50% down on where they were last year. That's for 2 reasons. Primarily because there's been an absence of stock in the market, or the right stock in the market, to appeal to investor appetite. And secondly, because 2011 was flattered by quite a large number of major investment transactions. Nevertheless, investment activity continues throughout Europe. And as you can see from this graph, this map, the hotter the colour, the more capital flows each of these markets have been attracting. So the more liquid markets, certainly of the UK and Germany, have been attracting a large proportion of that investment flow. But then more recently, we've seen an increase in appetite in Russia and in Poland. If we look at how that how those capital flows flow throughout Europe based on sort of growth prospects and market fundamentals, this graph shows on the bottom axis retail sales per capita for all European countries, and on the y-axis over there on the left, the retail growth prospects. Actually, naught is on this line here, so anything below here is forecast to see negative retail sales growth in the next 2 years. Anything above the line is forecast to see positive growth. And what we can see, if you relate back to those investment flows, is that 77% of investment flows to date have gravitated towards the sort of more mature established markets here in sort of Western Europe, as I said, UK and Germany in particular. The growth markets, including Russia, Poland and Turkey, have taken 14% of capital flows, and that trend will increase. Whereas, again, perhaps unsurprisingly, because of the headwinds in Southern Europe, as yet investment activity has really slowed. But retail investment is a global activity, and there is global appetite for retail investment, both here in Europe and elsewhere throughout the world. We've recently published a report, Redefining Retail Investment, Global Real Estate Futures, which looks at real estate investment in retail across the world. And it clearly identifies that the biggest retail investment market from 2009 to mid-year 2012 was the US, followed by the UK and Germany. That's on a global basis. So those top 3 investment markets account for 53% of total global capital flows in retail real estate. The countries that then follow, in particular here you can see China that's emerging in there, and no doubt we'll see China ascend these rankings as the investment market develops. So we're seeing a retail investment market that's being redefined on a global basis. And whilst Europe still is an attractive retail investment market, and there are plenty of opportunities, what we're seeing is the emergence of other retail investment markets throughout the world. And what we have here is the evolution of the retail investment market from frontier countries. We've identified places like Venezuela, Nigeria, and Algeria, through to the more advanced investment markets of the US, Australia, and Canada. And within there, a spectrum of evolution. The reason that the US, Australia, and Canada are in what we've classified here as the advanced market is primarily because of the type of ownership in the US, whereby a few major landlords hold the majority of the stock. And as such, with long holds, there is less liquidity in the markets than there has been in some of our European markets, for instance, such as UK, Germany, and France. But with an increase in equity investors looking for long-term holds and some of the REITs taking a longer-term position, it is likely that places like France, UK, and Germany will move into this slightly less liquid, more advanced stage. Equally, we've got places like China, Brazil, Russia, and Turkey here that are likely to continue up that evolution curve as they develop as retail investment markets. So redefining retail investment. It is unlikely, that we are going to see a flood of debt in the near term come to support the retail investment market in Europe. It is, for the time being, about equity. There is a large amount of equity in the market that is continuing to chase retail investment in Europe and beyond, and that is likely to continue. But they're very specific in terms of the type of stock that they are looking for. And in that respect, nothing has really changed in the last 12 months. It is still very much favouring prime retail, prime shopping centres in prime locations. The equity players are also looking to partner. And this partnering is a trend that we see continuing from here on. It's about partnering equity with expertise. Equity players from outside of the region coming to Europe, but wanting to partner with expertise, people that understand the market, best-in-class experts in the European retail scene. And whilst Europe leads on a global basis in terms of investment activity at an aggregate level. It is under threat from investment activity that will emerge in other markets, in particular in Asia, as the investment market develops there. But for the meantime, there's plenty of opportunity for investment activity in core Central Europe, and also as it emerges for investing in both Russia and Turkey and other emerging markets in Europe. So these global flows will continue to gravitate towards Europe, but again, it's very much focused on that prime stock and the best supply of stock, and it's unlikely to change in the near term. And what that's doing is forcing down yields on prime stock. It's supporting pricing on the best products in the market, whereas at the same time, secondary pricing is continuing to see deterioration. We're still seeing repricing of secondary, and we will more than likely see that for some time to come. So the divergence between pricing on the prime retail product and the secondary will continue. So to summarize, 10 quick takeaways for you, which hopefully summarizes everything that we've heard over the last few days, and no doubt there's a lot that's been missed here, but uncertainty is certainly still there in the market. We've just fallen back into recession, and that volatility, uncertainty is likely to remain for some time, but we seem to be getting quite used to that. On the back of that, economic growth and retail sales is likely to be subdued, albeit it will return. On the upside, across Europe, when you drill down at local markets, there are some pockets of growth, whether at a macro level, at a country level, and we've spoken at great length about Russia and Turkey and Poland, albeit growth is slowing a little in Poland, but also in core Western Europe. Across Europe, there are pockets of strong growth and strong market fundamentals. And in that respect, targeted retail expansion will continue. Retailers are expanding into new territories, which is very positive, and but they are being very selective in terms of where they are expanding. And again, the link back to the focus on cities across Europe, all across Europe and beyond. We mustn't underestimate the impact of digital, the impact of online, how it will reshape retail in a seamless multi-channel world. I think we're all coming to terms now with the extent to which retail will change the physical space and how retailers have to adapt. But different markets are at different stages of that evolution. In the UK, we anticipate that 25% of sales will ultimately go to online by 2020. And some of that will be click and collect, which will bring people back into the physical environment. The rest will be lost through internet sales. So it is a challenge for the physical retail environment, and a challenge for retailers to adapt their business models in order to adapt to this new multi-channel world. So against that backdrop, we will see further retailer optimization in the market as they look at their existing portfolios and they right-size, they downsize. They will open in new growth markets or where they currently do not have presence, where there is strong growth prospects. But equally, and bringing you back to the lease expiry profile, there will be plenty of opportunities for retailers to either renegotiate terms or simply to walk away from leases in poor locations that do not provide particularly strong prospects. We will also, no doubt, see further failure in the retail marketplace and retailers pulling out of countries that they've previously expanded into where they're not providing the return that they would expect. In Western Europe, we're unlikely to see a huge amount of new development, but we will see a lot of redevelopment. As I said, redevelopment becomes the new development in Western Europe, as does asset management. But we will continue to see healthy expansion of new schemes in the growth markets in Europe, in particular of Turkey and Russia. The retail investment market, with the absence of debt and the uncertainty in the market and the unknowns around how retail is playing out in this new era, means that we're unlikely to see an investor focus that goes beyond the best retail, the best stock in the market. So in that respect, the outlook for secondary still remains very similar to perhaps how it was this time last year. And this is fueling this two-tier market, as I mentioned, the prime versus the secondary. And finally, the internationalization of retail, of investment, is likely to continue. We are operating both in a retail context and a retail property context in a far more global marketplace, and we see that trend continuing. But also, when you have equity coming to the market, you also need the experience, and that's where the partnering also comes into play. And that partnering will be a factor that will continue to evolve going on. So just to finish off, I mentioned about adapting for change, and I still believe that we will be adapting for change for some time to go. Change is still playing out and will continue to do so. And in that respect, we need to continue to be mindful of the change and what's happening globally and how we respond to that in retail and in the physical retail environment. But equally, at some stage, whether it's subdued or otherwise, growth will return. And we also need to be positioned to growth to capitalize on the upside when it returns. And in some European markets, that growth is already there. Thank you. Does anyone have any questions?
Yes, I'm coming.
James, that was great. Thank you. A couple of questions. First of all, Europe has got an aging population. It wasn't really mentioned. In the States, it's having a big influence on retail, mixed use, living above shopping centres or very close to shopping centres in major urban areas has become a trend. Is it the same in Europe?
At an aggregated level, it is, yes. I mean, there are European markets that are forecast to see quite considerable population declines and an aging population over time. But equally, when you have places like Istanbul, which has an incredibly young population, so it's really market dependent. I'm not so sure that we'll see any seismic shifts towards doing anything in the short term to prepare ourselves for that aging population or shrinking populations, but it will have an impact on our retail marketplace.
And is medical a component of that? Is medical, as it is in the States, we're getting a lot of medical buildings becoming part of the urban areas to cater for the older population. Is that happening?
I'm not so sure that I'm not aware of it happening. It may well be happening. Although I think all these things need to be taken into consideration. I think the difficulty is looking to the long term when so many people are looking at the short term. But change has to happen because, as you said, in certain European markets there are aging and shrinking populations, and that will impact on retail.
Okay. Thank you very much.
Thank you. Any more questions? Okay. Thank you very much indeed. Enjoy your weekend. Thank you.